Welcome back to the Financial Crime Awareness Hub. In our last video, we covered Domain A of the Certified Anti-Money Laundering Specialist exam. The domain focused on the risks and methods of financial crime. If you have not watched that yet, the link is in the description below. In this video, we move to Domain B, Global Anti-Financial Crime Frameworks, Governance, and Regulations. This domain carries 20% of the total exam weight, which means 24 of your 120 questions will come from the content we are about to cover. We will go through everything the official Certified Anti-Money Laundering Specialist Handbook expects you to know. The FATF, the 40 recommendations, the UN conventions, FIU, the Egmont Group, the United States Regulatory Framework, European Union AML Directives, and the rules around correspondent banking. This is the regulatory architecture of the entire global anti-financial crime system. By the end of this video, you will understand how it fits together and how to answer Domain B questions with confidence. This video is brought to you by AdviseCube Consulting. Practice question banks, concise study notes, and a full e-learning course with an AI bot, built for working professionals preparing for financial crime certifications. Visit AdviseCubeConsulting.com to see the full range. Before we get into the content, let us understand why Domain B matters beyond its exam weight. Domain B covers the international regulatory architecture behind every anti-financial crime obligation you will ever encounter in your career. When your institution requires you to file a suspicious transaction report, that obligation exists because of national law, which itself exists because of international standards set by the FATF. When you apply enhanced due diligence to a PEP, that requirement traces back to a specific FATF recommendation, which was translated into national legislation, which your institution then built into its policy. Every compliance program in every financial institution on the planet, from UAE to the United Kingdom to the United States, ultimately traces its design back to the frameworks covered in this domain. Candidates who skip the detail on Domain B frequently lose marks on scenario questions that appear to be about operations, but are actually testing whether you know which regulatory framework applies and what it requires. 24 questions. Do not underestimate them. The Financial Action Task Force, FATF, is the most important organization in this entire domain. Every other standard, every directive, every national law we will discuss today builds on what the Financial Action Task Force established. The FATF was founded in 1989 by the Group of Seven Summit in Paris. Its original mandate was narrow: address money laundering from drug trafficking. That mandate expanded significantly over time to cover terrorist financing and, more recently, proliferation financing. Today, the FATF has 39 members, including major economies and 2 regional bodies. But its influence extends far beyond its membership through a network of FATF-style regional bodies, which we will cover shortly. The FATF has 2 mechanisms you must understand for the exam. First, the gray list. This is the list of jurisdictions under increased monitoring. A jurisdiction on the gray list has strategic deficiencies in its anti-financial crime framework and has committed to an action plan to address them. When you are dealing with customers or transactions connected to a gray-listed jurisdiction, you must apply enhanced risk management. Second, the blacklist, formerly known as the call for action list. These are high-risk jurisdictions with serious deficiencies. Financial Action Task Force members are called upon to apply enhanced countermeasures, which in practice means significantly heightened due diligence or, in some cases, restrictions on transactions. The exam distinguishes between gray list and blacklist treatment. Know both precisely. The 40 recommendations are the core output of the Financial Action Task Force, the international standard that every member country is expected to implement through national law. They are grouped into 7 clusters, and you need to understand what each cluster covers. Recommendations 1 and 2, Policies and Coordination, establish the risk-based approach as the foundation of all anti-financial crime work and require national coordination between all competent authorities. Recommendations 3 and 4, Money Laundering and Confiscation, require member states to criminalize money laundering across all predicate offenses, not just drugs, and to establish confiscation and asset recovery regimes. Recommendations 5 to 8, terrorist financing and proliferation, criminalize terrorist financing, implement targeted financial sanctions regimes, address proliferation financing risk. Recommendations 9 to 23, preventive measures. This is the largest cluster and the one most tested. It covers customer due diligence, record keeping, politically exposed persons, correspondent banking, wire transfers, new technologies, and obligations for designated non-financial businesses and professions. Recommendations 24 and 25, transparency and beneficial ownership. Legal persons and arrangements must be transparent. Beneficial ownership information must be available to competent authorities. Recommendations 26 to 35, powers and responsibilities. Financial intelligence units, law enforcement agencies, supervisors, and the sanctioning powers they need to function. Recommendations 36 to 40, international cooperation, mutual legal assistance, extradition, and all other forms of cooperation between jurisdictions. The exam focuses most heavily on recommendations 9 to 23, the preventive measures. Know these in depth. Before the Financial Action Task Force existed, before any of the modern compliance framework existed, 3 United Nations conventions established the legal foundation. The Vienna Convention, 1988, the full name is the United Nations Convention Against Illicit Traffic in Narcotic Drugs and Psychotropic Substances. It was the first international treaty to address money laundering directly. It required member states to criminalize drug-related money laundering and established the principle of confiscating the proceeds of crime. Every anti-money laundering law in the world today traces its legal lineage back to Vienna. The Palermo Convention, 2000. The full name is the United Nations Convention Against Transnational Organized Crime. Palermo extended money laundering criminalization well beyond drugs to cover all serious crimes. It addressed corruption, obstruction of justice, and organized criminal groups. It also introduced mutual legal assistance and extradition obligations between member states. The Merida Convention, 2003. The full name is the United Nations Convention Against Corruption. This was the first legally binding global anti-corruption instrument. It criminalized bribery, embezzlement, trading in influence, and money laundering. It introduced asset recovery as a fundamental principle of international law, meaning countries must cooperate to return stolen assets to their origin. Merida is directly linked to politically exposed person obligations and enhanced due diligence requirements globally. Know each convention by its year, its popular name, and its single most important contribution. The exam tests all 3. A financial intelligence unit is the central national agency responsible for receiving, analyzing, and disseminating financial intelligence. Every country that is compliant with Financial Action Task Force standards is required to have one. Banks, MSB, DNFBP, and virtual asset service providers file suspicious transaction reports, and in many jurisdictions, currency transaction reports above a threshold, typically $10,000, to their national FIU. The FIU analyses this information, identifies patterns and cases of potential financial crime, and disseminates its findings to law enforcement agencies and prosecutors who can act on them. FIU must operate with operational independence. They cannot be subject to political interference. This is an FATF requirement and a test of compliance effectiveness. 4 models of financial intelligence units. Administrative model. An independent body that acts as a buffer between the financial sector and law enforcement. This is the most common model globally, used by many major jurisdictions including the United States FinCEN. Law enforcement model. Embedded within a police or law enforcement agency. Provides direct access to criminal intelligence databases and investigative resources. Judicial or prosecutorial model. Operates under the judiciary or public prosecutor. Reports flow directly into legal proceedings without a separate dissemination step. Hybrid model. Combines elements of 2 or more of the above models. Common in jurisdictions that have evolved their framework incrementally over many years. The exam asks you to identify which model an FIU belongs to based on a description. Know the distinguishing feature of each. The Egmont Group is the global network that connects FIUs across jurisdictions. It does not set standards. It does not conduct mutual evaluations. Its purpose is to enable FIU to share information and work together operationally. The Egmont Group was founded in 1995, named after the Egmont Arenberg Palace in Brussels, Belgium, where that first meeting was held. Today, it has over 170 member FIUs from jurisdictions around the world, making it the largest network of its kind. The operational centerpiece of the Egmont Group is the Egmont Secure Web, an encrypted, controlled communication platform used exclusively for FIU to FIU information exchange. When one FIU needs to share intelligence with another about a cross-border case, it does so through this system. Membership in the Egmont Group is not automatic. A FIU must meet specific criteria. It must operate under a legal authority, with safeguards governing how information can be used, protected from misuse, and with the legal ability to share information internationally. The key exam distinction? The Egmont Group facilitates international cooperation between FIUs. It does not regulate. It does not investigate. It connects. The United States, U.S., has the most influential national anti-financial crime framework in the world. Even for candidates who do not work in the U.S., understanding this framework is essential because it shapes global standards and because U.S. dollar correspondent banking connects almost every financial institution on Earth to U.S. regulatory reach. The Bank Secrecy Act, 1970. The Bank Secrecy Act is the foundation of the U.S. anti-financial crime framework. It requires financial institutions to assist U.S. government agencies in detecting and preventing financial crime. Its core obligations include currency transaction reports for all cash transactions at or above $10,000, suspicious activity reports when a transaction involves funds from illegal activity or when an institution knows, suspects, or has reason to suspect illegal activity, and record-keeping requirements for international wire transfers. The Bank Secrecy Act is administered and enforced by the FinCEN, the U.S. FIU, which operates under the Department of the Treasury. The USA PATRIOT Act, 2001. The PATRIOT Act was passed 45 days after the September 11th attacks in 2001. It significantly expanded the anti-money laundering powers of the Bank Secrecy Act and extended anti-financial crime obligations to a much broader range of financial institutions, including securities brokers and mutual funds. Its most important additions for the exam are the Customer Identification Program requirement, which formalized KYC obligations, the prohibition on correspondent accounts for foreign shell banks, and the requirement for enhanced due diligence on correspondent accounts maintained for foreign banks from high-risk jurisdictions. The Financial Crimes Enforcement Network, FinCEN, is the U.S. FIU. It receives and analyzes suspicious activity reports and currency transaction reports from financial institutions across the country. It issues regulatory guidance, enforces Bank Secrecy Act compliance, and can impose significant civil money penalties on institutions that fail to comply. Under the Corporate Transparency Act, it also operates the Beneficial Ownership Registry for U.S. legal entities. The European Union, EU, has progressively built one of the most comprehensive anti-money laundering legislative frameworks in the world through a series of directives. Each directive added to and strengthened what came before. First Directive, 1991. The first directive aligned EU member states on money laundering for the first time. Its scope was narrow, focused exclusively on proceeds from drug trafficking, but it established the principle that member states must criminalize laundering and require financial institutions to report suspicious transactions. Second Directive, 2001. Extended the scope beyond drug proceeds to all serious crimes. brought DNFBP into the framework for the first time, including lawyers, accountants, and real estate agents. Third Directive, 2005, introduced the risk-based approach as the central organizing principle of anti-money laundering compliance, aligned EU law with the FATF 40 recommendations, introduced specific obligations around PEPs and enhanced due diligence. Fourth Directive, 2015, enhanced beneficial ownership registers, requiring all EU member states to maintain central registers of who ultimately owns and controls legal entities, strengthened PEP requirements, and expanded enhanced due diligence obligations. Fifth Directive, 2018, extended anti-money laundering obligations to virtual asset service providers and cryptocurrency exchanges for the first time, introduced public access to beneficial ownership registers, a significant transparency measure, added obligations around prepaid cards and high-value goods traders. Sixth Directive, 2021, harmonized the list of predicate offenses across all EU member states so that the same underlying crimes trigger money laundering obligations regardless of which member state is involved. Extended criminal liability to legal persons such as companies. Introduced tougher minimum criminal penalties. The exam tests progression, what each directive added. The fourth, fifth, and sixth directives appear most frequently in questions. Beyond the FATF and national frameworks, several other bodies shape anti-financial crime standards. You need to know what each one does, and, equally important, what each one does not do. Basel Committee on Banking Supervision. The Basel Committee operates under the Bank for International Settlements and issues supervisory guidance to banks globally. Its CDD paper is a key reference document for KYC standards at the institutional level. The Basel Committee does not set law. It issues guidance that national regulators and banks adopt into their frameworks. The Wolfsburg Group. The Wolfsburg Group is a private sector association of 13 major global banks, including names such as HSBC, Deutsche Bank, Citigroup, and others. It publishes voluntary principles and guidance on anti-money laundering, counter-terrorist financing, sanctions, and correspondent banking. It is not a regulator. It cannot enforce. But its guidance carries significant industry weight and is frequently referenced in compliance best practice. Financial Action Task Force-style regional bodies. These are associate members of the FATF network that apply FATF standards within their geographic regions. Examples include the Asia-Pacific Group, the Middle East and North Africa FATF, which is directly relevant to candidates working in the Gulf region, the Caribbean FATF, and others. They conduct their own mutual evaluations using the FATF methodology. International Organization of Securities Commissions. This is the international body for securities regulators. It sets standards for anti-money laundering compliance in capital markets, investment firms, and securities exchanges. As financial crime increasingly exploits capital markets through market manipulation, insider trading, and layering through securities, this body's relevance to the anti-financial crime professional has grown significantly. Know which bodies set standards, which enforce, which facilitate, and which are private sector.
Correspondent banking is one of the highest risk relationships in the global financial system. And it is covered specifically in Domain B because of the regulatory obligations it triggers. What is correspondent banking? A correspondent banking relationship exists when one bank, the correspondent bank, provides services to another bank, the respondent bank. This is typically done to facilitate cross-border payments in currencies or markets where the respondent bank has no direct presence. The critical risk is this. The correspondent bank is processing transactions on behalf of the respondent bank's customers, people and entities it has never directly screened. The correspondent bank is relying entirely on the respondent bank's customer due diligence. If that due diligence is inadequate, The correspondent bank has unknowingly processed transactions for customers it would never have accepted directly. Nesting makes this worse. Nesting occurs when a respondent bank itself has correspondent relationships with other banks, meaning the chain of separation between the correspondent and the ultimate customer becomes even longer and less transparent. Regulatory requirements for correspondent banking. Know your respondent. Before establishing a correspondent relationship, gather sufficient information to fully understand the respondent bank's business model, customer base, ownership structure, and regulatory environment. Assess the controls. Evaluate the respondent bank's anti-money laundering and counter-terrorist financing controls. Are they robust? Are they independently audited? Do they meet the standards you would apply to your own customers? Senior management approval. New correspondent banking relationships must be approved at senior management level. This is a FATF requirement and is reflected in national law across most major jurisdictions. Prohibition on shell. Bank accounts. The United States PATRIOT Act prohibits correspondent accounts for foreign shell banks, banks that have no physical presence in any jurisdiction. This prohibition has been adopted broadly across major financial centers. Payable through accounts. These require special enhanced due diligence because they allow the respondent bank's customers to access the correspondent bank's services directly. The correspondent bank must understand who has this access. Correspondent banking questions appear in both Domain B and Domain A. In Domain B, the angle is regulatory obligation. In Domain A, the angle is risk typology. Domain B is a knowledge-heavy domain. It requires you to hold a significant amount of regulatory detail in your head, and then apply it to scenario questions under exam pressure. Here is the structure that works. Phase 1. Build the architecture. Do not start with the detail. Start with the hierarchy. Draw it out. UN conventions at the top. They are the international legal foundation. Below them, the Financial Action Task Force, which translates those legal principles into standards. Below that, FATF regional bodies and national law. And at the base, institutional policy, your bank, your compliance program. This hierarchy tells you which instrument does what. UN conventions create legal obligations between states. The FATF creates standards that states implement. National law operationalizes those standards. Institutional policy implements national law. Once you have this hierarchy clear, every Domain B question becomes a question of, where in this hierarchy does this obligation come from? Phase 2. Learn the key instruments. Know each UN convention by its popular name, its year, and its single most important contribution. Know the FATF 40 recommendations by cluster, not by individual number. Know the Bank Secrecy Act and Patriot Act by their specific obligations, not just their names. Know the progression of European Union directives, what each one added. And critically, know who sets standards versus who enforces them. The Financial Action Task Force sets standards. The Financial Crimes Enforcement Network enforces. The Egmont Group facilitates. The Wolfsburg Group advises. These distinctions are tested. Phase 3. Apply to scenarios. When you encounter a Domain B scenario question, your first task is to identify the relevant framework. A question about a suspicious transaction report is a national law question, usually Bank Secrecy Act or its equivalent. A question about a gray-listed jurisdiction is a FATF question. A question about public beneficial ownership registers is a European Union Fifth Directive question. Identify the framework first, then apply what you know about its specific requirements. Before we close, let me tell you about the resources available through AdviseCube Consulting, built specifically for working professionals preparing for financial crime certifications. AdviseCube offers practice question banks covering all 4 domains of the Certified Anti-Money Laundering Specialist exam, including the regulatory framework questions in Domain B that candidates often find most challenging under exam pressure. The questions are scenario-based and written to reflect the difficulty and format of the actual exam. The study notes are concise and written for professionals who do not have hours to read textbooks. They cover the key frameworks, distinctions, and exam-relevant points across multiple financial crime certifications. Visit the website to see the full range of certifications covered. And AdviseCube has a full e-learning course available on Coursebox, with an artificial intelligence bot trained specifically on certified anti-money laundering specialist material. You can ask it questions about the FATF, FIU models, or UN conventions at any time of day and get immediate, accurate explanations. It is available 24 hours a day, 7 days a week, designed for professionals who study around a full-time career. Visit AdviseCubeConsulting.com to see everything that is available. You can also reach the team on WhatsApp as well, or by email at info@AdviseCubeConsulting.com. That is Domain B, the complete global regulatory architecture behind anti-financial crime compliance. From the UN conventions that created the legal foundation, to the FATF 40 recommendations, to FIU and the Egmont Group, to the United States Bank Secrecy Act and PATRIOT Act, to the 6 European Union anti-money laundering directives, and the specific regulatory treatment of correspondent banking. If this video helped your preparation, please like it. It helps other candidates preparing for the same exam find this content. Subscribe to the Financial Crime Awareness Hub if you have not already. Domain C is next, building an anti-financial crime compliance program. That domain also carries 30% of the exam weight, and it covers everything from customer due diligence to suspicious activity monitoring and the compliance officer's role. Leave a comment below. Which regulatory framework do you work under in your current role? I read every response. And if you are ready to practice, AdviseCube is waiting for you. Practice questions, concise notes, and an e-learning course with AI-trained bot on the exam material. Available now at AdviseCubeConsulting.com. I will see you in the next video.